It presents an opportunity for us to recount our history, picking the lessons it teaches, and thereby forging a new path for progress and development.
Promises are being fulfilled. Ghana made $3 billion in 4 months without discovering a new gold mine. How did they pull that off? Spoiler alert, Ibrahim Traoré has something to do with it. But what really? Let's find out. For decades, Ghana has been a glittering name on the world map of gold production. A top-tier producer, it sat proudly alongside South Africa and Sudan in Africa's Golden Triangle. Yet despite this natural wealth, the country rarely saw the true benefit of its underground treasures. Billions of dollars in gold left Ghanaian soil year after year, but only scraps made it back into the national economy. The problem wasn't the lack of gold, it was the lack of ownership. This has been the silent tragedy of Ghana's mining sector, having everything but controlling nothing. The country's gold mines were largely operated by foreign multinationals, firms based in Canada, the UK, South Africa, and Australia. These companies extracted the gold, processed it offshore, and sold it to global buyers under private contracts. Ghana's role? To provide the dirt, take a small cut, and stay out of the boardrooms where the real money is made. And it wasn't just the gold that left. Data, pricing control, and profit transparency are left with it. Many mining firms underdeclared their earnings, exploited regulatory gaps, or simply structured their businesses in ways that made tax avoidance legal. By the time government officials got involved, the profits had already disappeared overseas, hidden in corporate spreadsheets and offshore accounts. For years, Ghanaians asked themselves, how can we be so rich in resources, yet still struggle with debt, unemployment, and a fragile currency? The answer, until now, was silence. And silence became normal. But early in 2025, that silence was broken, not by a politician, not by a protest, but by numbers. Quiet, unemotional numbers. Between January and April, Ghana's gold revenue skyrocketed to $2.7 billion. That's more than triple what it earned in the same period just 2 years earlier. Not only that, the amount of gold exported nearly quadrupled, from roughly 7,500 kilograms in early 2023 to over 30,000 kilograms in just 4 months. These weren't estimates or hopeful projections. These were real transactions, tracked through Ghana's customs authority and recorded in the books of its central bank. So naturally, people asked, where did all this come from? Did Ghana suddenly find a new gold reserve? Did mining production suddenly shoot up overnight? The answer was far more interesting and far more important. The gold was always there. Ghana just finally stopped letting it vanish. What changed wasn't the mines. What changed was who controlled the exits. For the first time, Ghana wasn't letting private companies dictate what was left on the ground and where it went. There was a gatekeeper now. And behind that gate stood a new vision, one that didn't come from Accra. It came from a neighboring capital, Ouagadougou. You see, the Ghanaian government hadn't just stumbled upon a lucky quarter. They had studied something, watched someone, and they were no longer satisfied being a passive participant in the mining economy. Inspired by new leadership on the continent, they had made a choice, a very deliberate one. But to understand that shift, how a quiet, policy-driven move sparked billions in sudden revenue, we need to follow the influence behind it. Not a think tank, not the International Monetary Fund, not even the African Union. It came from a man in a green beret, a soldier, not a scholar, a leader who had taken a broken country and dared to break the rules of global economics. Captain Ibrahim Traoré. Ghana didn't invent the new model, but when they saw it, they didn't hesitate. They adapted it. And the moment they did, gold stopped being an export. It became a weapon of sovereignty. But how did Traoré's actions in Burkina Faso reach Ghana's parliament? And why did President Mahama, a civilian leader with no military background, embrace a model born out of military revolution? To truly grasp how Ghana went from silent observer to gold gatekeeper, you must understand what Traoré represented, not just as a person, but as an idea. The wave of change Ghana rode didn't begin in its capital, Accra. It began in Burkina Faso, under the command of a 36-year-old military officer who had no background in economics, no Wall Street endorsements, and no international approval. But what Captain Ibrahim Traoré did have was clarity, and the courage to say what others only whispered: Africa's wealth is stolen not with guns, but with contracts. That clarity echoed far beyond his borders. When Traoré came to power in 2022, many dismissed him as just another military man in a fatigued region used to coups. But then he did something strange. He didn't privatize the state. He didn't beg for IMF funds. Instead, he looked at the gold flowing out of his country and said, "Stop." He banned raw exports, built a national refinery, and refused to sell a single gram unless it benefited the Burkinabe people first. It was a direct attack on the logic of post-colonial economics, and it rattled capitals from Paris to Washington. But in Accra, it sparked a different reaction. It sparked interest. At first, it was quiet. Some murmurs in Ghana's parliament, think tanks running numbers, cautious discussions in economic circles. Could such a bold model work in a more advanced democracy like Ghana? Could a country tied into international trade networks dare to cut out the middlemen? The real test came when John Dramani Mahama returned to power in early 2025. Mahama's previous leadership had been marked by economic difficulties and criticism for maintaining the status quo. But this time, something had changed. He came back not with flashy speeches but with structural intent. Within weeks, the signs were clear. Mahama wasn't planning to run the old playbook again. Instead, he was preparing to rewrite it entirely. And the one blueprint sitting on his desk? It wasn't from the World Bank. It was from Burkina Faso. Why would a democratic civilian president model his economic turnaround on a military-led revolution? The answer lies in the results. Traoré hadn't just made speeches. He delivered measurable victories. His gold reforms had tripled national reserves, stabilized local currency value, and even allowed Burkina Faso to reduce dependency on foreign aid. While Western analysts framed it as radical, African leaders saw something else: proof. Mahama wasn't borrowing a military uniform. He was borrowing a working formula. And unlike Traoré, Mahama had the advantage of infrastructure, a more established financial system, and greater international visibility. That meant he could do what Traoré did, but at a bigger scale, faster, and with less resistance from within. So he began laying the groundwork. Here's a reminder to please like and share the video and subscribe to our channel to watch more videos on Black culture, history, civilization, and identity. Let's continue now. The first sign of the shift came quietly: the formation of a new national body to oversee gold, the Ghana Gold Board. It wasn't just another bureaucratic agency. It was modeled directly after Burkina Faso's national oversight of mineral wealth. Like Traoré's vision, it aimed to end foreign dominance over gold decisions. But the inspiration went deeper than structure. Mahama began echoing Traoré's deeper principle. Gold is not just a commodity, it's political power. And unless African states controlled it directly, they would never have full sovereignty. Where previous administrations had been willing to negotiate with foreign miners for better terms, Mahama took a sharper stance. If you want Ghana's gold, you play by Ghana's rules. Period. This policy wasn't just about economics. It was about ideological realignment. Ghana was signaling to the world that it no longer saw wealth as something to be attracted through investment conferences or tax holidays. It saw wealth as something already buried beneath its feet, and now ready to be defended. Of course, adopting the Traoré model wasn't just about copy-pasting policies. Ghana had to adjust it for its context. Unlike Burkina Faso, Ghana was a regional financial hub, a democracy with long-standing investor relationships. It couldn't afford a shock strategy. It needed a quiet revolution, one that could turn heads without sparking backlash. That's exactly what Mahama crafted. Within weeks, policies once thought impossible became law. Foreign gold traders found themselves locked out unless they followed strict national regulations. Multinationals were forced to surrender part of their output for state reserves, and every ounce of exported gold passed through the Ghana Gold Board's hands. None of this would have happened without the confidence of a living example. And that's what Traoré gave Mahama. Not a direct partnership, but permission to be bold. What followed wasn't just policy, it was a profit. And with that profit came power. Not just financial power, but diplomatic leverage. But the real game changer was still ahead. Because once Ghana had control over the gold, the question became, what would they do with it? Once Ghana accepted the Traoré model, the next step wasn't philosophical. It was practical. Take back control and lock the vault. There was no turning back. Inspiration had turned into legislation. But now came the hardest part: enforcement. And that's where Ghana became bold in a way that stunned observers both at home and abroad. Following the creation of the Ghana Gold Board, the new state powerhouse tasked with overseeing the sector, the Mahama administration wasted no time. It rolled out a set of policies that not only rewrote the country's mining rulebook, but flipped the entire power dynamic. One of the first shocks was the mandatory 20% Doré bar handover. This was not a symbolic gesture, it was a command. Every mining company operating in Ghana, local or foreign, was required to surrender 20% of their refined gold in physical form to the gold board before they could export a single ounce. Why Doré bars? Because raw gold is easily manipulated. It can be underreported, mixed with impurities, or sold off through shady channels. But Doré, semi-pure gold bars, is traceable. It's a financial fingerprint. By demanding this form, Ghana made sure it was seeing what was real, not what was declared. This policy immediately put pressure on foreign companies that were used to shipping gold out under private contracts with minimal state oversight. Now, they had to prove everything, and they didn't like it. Some firms threatened to pull out. Others lobbied quietly, hoping to soften the rules. But Ghana stood firm. Backed by rising gold prices globally and a population tired of being looted through legal means, Mahama's government called their bluff. And the results came in fast. Ghana's central bank reserves began to swell. Within 3 months of the new policy, gold holdings surged from under 9 metric tons to over 30 tons, a figure that shocked international financial observers. These weren't digital numbers on a screen. This was physical gold, held in state vaults, representing real value and real freedom. With that gold came monetary sovereignty. Ghana, like many African nations, had long depended on foreign currency reserves, mostly US dollars, to stabilize its currency and pay for imports. But dollars come with strings: IMF conditions, currency volatility, political pressure. Gold? Gold has no master. Now armed with a bulging reserve of a universally respected asset, Ghana began to push back in subtle but powerful ways. International lenders who once dictated harsh terms now had to negotiate. Investors who once demanded tax holidays now had to compete with a rising domestic industry. Even the country's central bank could afford to be more assertive in managing the cedi, Ghana's currency. But this newfound power wasn't just economic, it was strategic. Ghana used its rising reserves to pivot its trade approach. Instead of relying purely on dollar-denominated deals, it began exploring barter arrangements and bilateral trade using gold as collateral. Rumors surfaced of talks with Asian and Middle Eastern nations to supply refined gold in exchange for energy, machinery, and infrastructure investment, all without touching Western financial systems. And at the center of this shift stood one iron rule: Ghana's gold doesn't leave unless Ghana gains. To protect this rule, Mahama's administration took another major step: a near-total freeze on foreign gold traders. Unlike the past, when dozens of international firms, especially from the UAE and Switzerland, roamed Ghana's markets snapping up gold at below-market prices, the new policy tightened the ring. Only vetted state-approved entities could now participate in the export ecosystem. And even they had to comply with strict guidelines regarding transparency, taxation, and reinvestment into the local economy. At first, critics warned this would scare away business. But the opposite happened. With the clear rules and government guarantees, a new wave of local entrepreneurs and investment groups stepped up. Small and mid-sized Ghanaian companies, once suffocated by foreign dominance, began building refining facilities, trading houses, and logistics networks. They no longer needed to ask for permission. The gates were open for them, and closed for those who once dictated the terms. In parallel, Ghana increased funding for technical training programs, offering young Ghanaians the skills to enter mining, metallurgy, and mineral finance. Within months, new jobs were being created, not in the mines but in the value chain around them. For the first time, gold was building industries, not just headlines. But none of this happened in a vacuum. It was the natural evolution of the policy shift described before. Ghana had admired Traoré. Then it mimicked him. But here, in this phase, they surpassed even his ambitions. They didn't just stop the bleeding. They started growing new organs. Ghana's gold was no longer a passive resource. It was now a lever, a shield, and a sword. The country had gone from export victim to value creator. But while gold built the foundation, the real transformation was still coming. Because the biggest impact wasn't in how Ghana dealt with its economy. It was how other African nations began to watch and take notes. Gold was once the chain. Now, in Ghana's hands, it had become the key. By the time Ghana transformed its export policies, increased its reserves, and kicked out parasitic foreign traders, it wasn't just building wealth. It was building a blueprint. But the real power of a blueprint isn't in its beauty. It's in its ability to be copied. And that's exactly what started happening across Africa. Other nations were watching Ghana closely. In embassies, parliaments, and presidential security briefings, a new question began to echo through the halls of power. If Ghana can do it, why can't we? This wasn't just envy, it was a realization. Realization that the old model, dig, export, hope, was no longer sustainable. Ghana had proven that there was another way, one that required courage more than capital. And in that moment, Ghana went from being a gold producer to a continental example. In Mali, where political upheaval had already caused friction with Western partners, whispers of doing it the Ghanaian way began circulating in state-controlled mining ministries. Officials there had long been concerned that over 60% of their gold was leaving the country undeclared, smuggled through shadow networks, or siphoned off by powerful foreign entities. Now, with Ghana showing what centralized oversight could achieve in just months, Mali's transitional leaders began drafting plans for a gold board of their own. In Niger, a country facing economic pressure after cutting ties with France, the lesson was even clearer. If you want to survive isolation, you need internal strength. You need reserves, not debt. And what better way to build reserves than controlling your most abundant natural asset? Even countries not currently under sanctions started to rethink their structures. Tanzania, with its vast gold belt and history of struggling against foreign mining conglomerates, took a renewed look at its local ownership laws. Talks began to resurface about reintroducing mandatory value addition policies that had been shelved years ago under pressure from investors. But perhaps the most symbolic moment came from Zimbabwe, long accused of economic mismanagement and weighed down by international sanctions. For years, Zimbabwe's gold trade had been marked by accusations of corruption and smuggling. But in early 2025, a senior economic advisor to the president publicly praised Ghana's gold model, calling it a 21st-century Pan-African answer to colonial economics. That was not just flattery, it was a signal of intention. What made Ghana's approach so contagious was its simplicity. It didn't require military coups or ideological revolutions. It required something much more subversive, saying no to foreign rules and yes to national interest. That shift in mindset, from appeasement to assertion, is what began rolling the dominoes across the continent. And Ghana didn't just passively inspire it. The country began actively engaging other African leaders, quiet meetings, trade forums, strategic summits. The Ghana Gold Board even opened communication channels with regional partners to share technical expertise on tracking, refining, and trading gold through state systems. For the first time in decades, a model of African cooperation that didn't rely on Europe or the US was being born. It wasn't based on charity, loans, or aid packages. It was based on raw wealth, refined internally and traded on African terms. And that had the West nervous. International mining lobbies began issuing reports about resource nationalism, threatening investor confidence. Western think tanks warned of rising authoritarian models in resource governance, thinly veiled jabs at Ghana and Burkina Faso. Financial journalists speculated on whether this trend could undermine foreign direct investment, but they missed the point. This wasn't about scaring away investment. It was about changing the rules of that investment. African countries weren't rejecting partnership. They were demanding partnerships built on respect, not exploitation. And Ghana had shown that it could be done. not through isolation, but through firm policy and internal control. Yet perhaps the most profound impact of Ghana's gold shift isn't in legislation or export earnings. It's in psychology. Across Africa, young people, entrepreneurs, engineers, students, began to talk about gold not as some distant government matter, but as a tool of empowerment. They saw that wealth didn't have to come from abroad. It could be created, protected, and used here on African soil. Traoré had lit the fire. Ghana had fanned the flame. Now the continent was warming to the idea that freedom could be measured in tons, not tweets, and that changes everything. Because when one country breaks the chain and survives, even thrives, it gives others the courage to break theirs. Ghana's $3 billion wasn't just a windfall. It was a signal that the age of silent wealth extraction was ending, and the age of sovereign resource power was just beginning. Do you think it is too late to stop Africa from progressing? Let us know in the comment section. Have both the youth and leaders decided to do what is right? Do you want to watch more videos like this one? If so, subscribe to our channel and press the bell icon next to it. We have decided to bring videos on something nobody talks about: the Black culture, civilization, history, and evidence about how glorious Blacks have been. Thanks for watching, and until the next video, stay tuned.